Up. Please bring your quizzes in. Time is up. Time is up. Please bring your quizzes in. No more writing. Please bring your quizzes in. Time is up. All quizzes in, please. Okay, all quizzes in? All quizzes in, please. Okay. Okay, so you know how this process works if you've taken my corporate finance class, but if you haven't, let me explain how this will work, okay? Okay, so your quizzes will shortly be picked up by the TAs who will alphabetically sort it. So sometime in the next hour or so, they will get magically sorted, and I will start grading. I actually have an all afternoon session somewhere that I've got to be talking at. But I'll start grading when I start grading. And I'll finish grading when I finish grading. And once I record all the scores, I'll send you an email saying your quizzes are ready. And they will be actually ready on the 9th floor, face down, alphabetically. That's why I asked you to write your name on the back, right? So I didn't want your autograph, so if you can't read your own name, it's your own damn fault. If I can't read your name, and then it's really doubly your damn fault. So hopefully one of the two names is readable, and it's really your name. So I will record the scores. I will say, come and pick up the quizzes. I will send you the solution with the grading template next to it. There's no mystery or there's no subjective judgment. So you'll see essentially, there's obviously partial grading, so I'll tell you where you lost the points. But if you think I've been unfair, don't bitch and moan, don't stew in your own juices, just come on in and tell me what you think I've missed. Okay? And if I missed something, I will add the point on. I'm not going to sit there and argue about half a point. My life's too short to do that. But don't make this your standing point, that you're going to come in and argue about a half a point you don't deserve. Because the other way I can save my time is say no, and it's over. So it's if it's debatable, I'm willing to debate. If it's not debatable, then I'm not willing to debate. I know this is going to be painful to revisit something right after you've done it, but very quickly. This was actually a very compartmentalized quiz. Did you notice that? Each problem was testing you on a different thing. Let's start with the first problem. I gave you the cash flow, right? I actually screwed up on one of the versions of the quiz you had. So if you had Comstock, the cash flow should actually have been 750, but you got 700. But I because it was my screw up, whether you 700 or 750, because that wasn't the objective of the problem. The problem is, given this cash flow that you see up there, which of these 6 discount rates should you use? So can you visualize what you saw on that first page? What measure of income did I start with? You remember the very first line? No, you've already forgotten? Yes. It said taxable income, right? Already I'm giving you a clue. I didn't say operating income. I said taxable income. And then I kept going, just in case you didn't get that clue. I added depreciation. I subtracted out capital expenditure. I subtracted out change in working capital. And then I kept going. Did you notice that? There were 2 extra line items. One said debt issued, and the other said debt repaid. And I came up with cash flow. Usually when I say cash flow, I'm fairly careful about extending it out. I left it as cash flow. Let me ask you a question. Whose cash flows are these? And why are they? What is it about what I've done that made them equity cash flows? Already saying, oh shit, I can see the oh shit look on your faces. But kind of let it go, right? Think of it as a learnable moment. Okay? Okay? It was a cash flowed equity, and what gave it away was the fact that I started with taxable income, which is after interest expenses, and I gave you a second clue in case you didn't get it, that I added debt issued anytime you see cash flows from or to debt. By definition, that cash flow is to equity investors. So already two columns, so if you look across, one row of that table goes away, right? So you should not be, I saw quite a few 8.5%. So you're not alone if you screwed up on this. Trust me, I saw about half the class come in with 8.5%, which is the cost of capital. In this case, the other choice you had to make is whose discount rate should I use? And we went through the Kennecott. Remember the start of the class test we did? Way back, second session, third session. Cash flows to equity for a target company. The discount rate you use is the cost of equity for the target company. That is the bulk of the problem, so don't complain to me when you lose that 1.5 out of 2.5. The rest of the problem is just plugging the number in, right? You got the cash flow, you got the discount rate, and I gave you the growth rate. I'll give you a point. That's actually a gimme, right? Because you put the three numbers together. But the discount rate was the big part of that problem, getting it right. Because if you get it wrong, the rest of the problem is irrelevant. Second problem was about two issues. One is get a risk-free rate in a currency where there is no default-free entity. For half of the class, that was Turkey. For the other half, it was Hungary. I gave you a government bond rate in the local currency for both countries. The government bond rate is not risk-free. Why? Because I also told you in the problem that the sovereign default risk for this government is the same in both local currency and foreign. So there's no wiggle room here, right? You can't say, well, I assume the local currency was default-free. And then I gave you the information to back out the spread for the foreign currency bond. In what form? What is in the second column? I gave you government bond rates in euros, or actually gave you the CDS spread, right? I gave you the CDS spread, so I gave you the default spread, and then all you had to do is subtract that default spread from the government bond rate to get to a risk-free rate. I think it was 4.5% for both Turkey and Hungary when you subtracted it out. The other part of the problem, of course, was getting the equity risk premiums, pure because I gave you the revenues, but the one twist was that you were splitting off a half the company, the European part, and I gave you Turkey and Hungary's, or Germany and Turkey and Germany and Hungary's revenues. You had to take a weighted average. The third problem was about just can you weight betas, and can you lever and unlever. By this point in time, you shouldn't be looking at your notes for the unlevered beta equation. I mean, every quiz I've given you in this, especially if you're taking my corporate finance class. At this stage, you've had 4 quizzes and a final exam and a project all using that prompt, basically of unlevering and relevering beta. So one thing I did not give you was the debt to equity ratio for this company, but I did give you the information to back into it. And the last problem was just taking what we did in R&D and applying it to recruiting and training expenses, right? So it's pure mechanics. And I even took away the messiest part of the problem by asking you for the pre-tax operating income. The after-tax is a little messy because you're getting this entire deduction, so rather than kind of push you into that quicksand, I just left it at a pre-tax number. So you'll get the quiz back, and so stop thinking about it. That's like saying, don't worry about sunk costs. It's not going to happen. It's done. But you will get it back sooner than you think. Okay? So let's go back to what we were talking about. We were talking about growth, and we were talking about the dangers of looking at historical growth. The dangers of looking at a historical growth number and treating it as a fact. We said that number you get for past growth can vary depending on starting and ending points. And as I told you, one of the dead giveaways that somebody's playing a game with you on growth rates is if your starting year is 2009, any kind of analysis, you know what this person is trying to do. 2009 is an awful year. If you make that your base year, you're trying to inflate growth rates. Starting and ending points matter. How you compute the growth rate matters. Arithmetic averages versus geometric averages. If you remember the Motorola example, the difference started to diverge as you went from revenues to EBITDA to EBIT to net income to earnings per share. The more variable a number is, the bigger the difference. When the difference is big, go with the geometric average. We talked a little bit about negative to positive numbers. If you remember the example I gave. And in fact, I want to start with that. If you go from a negative earnings to a positive earnings, if you just take the standard growth formula, you're going to get a number that makes no sense. So if you go from minus 5 cents to plus 5 cents, plugging the numbers in, you get a negative growth rate, even though you went from a bad year to a good year. And people try to play games to get around it. They use absolute numbers, they use the higher of the two numbers. But the bottom line is, when you go from negative to positive numbers, you cannot compute a growth rate. A growth rate becomes meaningless. You can still tell me that was a good year to go from negative to positive and leave it at that. One final point about growth, which we know mathematically, but it's so easy to forget. It's easy to grow when you're a small company, in percentage terms. Have you ever watched The Biggest Loser? So where you get really, really big people and they come on, and each week they're measured based on what? Percentage weight loss. So if you start the first week of the show, you got 800-pound, 700-pound people, and they lose 15%. Why? Because they have a lot of weight to lose. Each week, if you look at the percentage changes, they get smaller and smaller. They're working harder and harder, but losing 15% of your weight when you're 100 pounds could probably kill you. So as you get smaller, the percentage changes get... With earnings growth, it's the other direction. As you are small, it's easy for you to post percentage increases. So if you had $1 in revenue last year, doubling it just means an extra $1. You're at $1 billion in revenues. Doubling it is a lot of work you have to do. Intellectually, we all get it. But sometimes when you're sitting there with a spreadsheet, it's easy to forget. About 2 semesters ago, there's somebody in this class who I will leave unnamed, which is good, because that's probably a privacy thing I should not be violating, though I do violate other things. And he was valuing Netflix. And he came up with the value for Netflix of $500 per share. Now, there are a lot of people disagreements about how much Netflix is. What stock's trading at 100? So basically 500 is 5 times the value. But Netflix is a really tough company to find undervalued. So even if you find it undervalued, you're stretching, you're getting to 115, 120, and then it's a real stretch. And he got 500. I was curious, because this was a remember you have this is a good time for me to remind you that there is a project on which you're going to be doing a DCF, that there's a mid-semester feedback that I will give you if you turn in your DCF. Okay? I know it's a bad time to remind you, but somewhere in about 2 or 3 weeks, I'll say, where's your DCF? And you say, what DCF? Think of this as your reminder. So mid-semester, I ask for the DCFs, and he turns in his DCF with a $500 value per share. I look at his numbers. So I'm curious, where did he get the 500? Look at his revenues in year 10. And he has $600 billion in revenues. $600 billion. So I called him in to my office and said, can you come in and talk to me? I need to ask you a couple of questions. So when he came in, I said, do you have Netflix? He said, yes. I said, how much do you pay per year? Pulls out his calculator. His calculators seem to be attached to him. About $100 a year. I said, let me get this straight. You have $600 billion in revenues in year 10. Roughly speaking, you pay $100. Let's ignoring inflation. How many subscribers would Netflix need to have? He pulls out his calculator again. I said, you don't need a damn calculator. You got 600 billion, divide by 100. That is, you knock off the zeros, you forget the billion. No, don't forget the billion, because that might be the problem. You've got 6 billion users. I said, what's the population of the world? He said, I don't know where this is going. I said, just hang in there with me, right? He said, I have to look up Wikipedia. I said, you don't have to look up Wikipedia. Let me throw a rough number in your direction. How about 5.5 billion people? I know there's growth in the world population. So maybe by year 10, you can get to 6 billion. He's saying, this is now possible. So then I asked him the final question. Is there a law that I'm not familiar with that you see coming, passed maybe by the United Nations, that every man, woman, and child on the face of the earth has to own a Netflix account and is not allowed to share. He said, don't be absurd. I said, I'm not the one who came up with $600 billion in revenues in year 10. How the hell did you come up with $600 billion? He told me. He said he took the revenues in the most recent year. He took the growth, the subscriber growth over the last 5 years in percentage terms, and he applied it every year for the next 10 years. He said, I was just using the numbers. That's part of the price of, no, it's a price we pay for letting spreadsheets do it for us, right? So it's so easy. Just copy the formula down. You can keep doing this forever. In fact, if you hadn't stopped in year 10, I'm scared to think of what would have happened if you got to year 25. So when you project growth out for your company, especially when you're talking about revenue growth, here's what you need to check. Get to year 10, and as you go through time, think of the incremental change in dollar terms. That's kind of sobering. If you have a retail firm like Amazon with $100 billion in revenues and you put on a 50% growth rate for next year, what are you telling me? That they need $50 billion in additional sales next year. Think about the dollar change in addition to percentages. So here's an example of how percentage changes can completely throw you off. Now, how many of you play golf? But in the 1990s, Callaway Golf came out of nowhere as a company. They invented this club called the Big Bertha, a huge seller. This actually reflects what it did for them. And it basically, what it did for them, it made them go from being a small company to a big company. Their net income went from $1.8 million to $122.3 million over a period of 5 years. The geometric average growth rate was 102% a year. They were basically doubling their size each year. So let's say you're in 1997, you're sitting down to value Callaway Golf, you see the 102% growth rate, you decide to apply it as your growth rate for the next 5 years. Here's what's going to happen. Your $122 million in net income will become $4.1 billion in net income. If you translate that into revenues and number of clubs you'll have to sell, you will probably require every family in the US to buy a Big Bertha even if they don't play golf. Maybe you can sell this as a weapon. I don't know, maybe there is a story you're telling me that you're not completing. But here again, the dangers of compounding. It's easy intellectually to get it. But I tell people, just take a number. Take a 20% growth rate, try to guess what the end number will be in 10 years. Then double the growth rate, try to guess what you will consistently underestimate what the effect of changing growth rate is. A 2% change in growth on a compounded basis can translate into a huge change in revenues in year 5 or year 10 when you go out in the future. Just test the numbers out before you actually use that growth rate. So historic growth is good to know, but it's not the end game. In fact, I'll close historic growth with one final story. This is as long as people have been valuing companies. This is a question of should we rely on past growth? After all, that's the number you have on your table. The last 5 years, last 10 years. So in the early 1960s, a guy called IMD Little, the IMD were his initials, Little was his name, comes over from the UK to do a PhD in the US. So he wants to test something. So he decides to test this proposition. Is past growth a good predictor of future growth? Remember, this is 1962. You don't have access to big databases. You've got to build the database yourself. So that kind of constrains you in how big your data is. So here's what he did. He took every US company, estimated the growth from 1952 through 57. Then he estimated for each company the growth from 57 to 62. So 2 5-year periods next to each other. So what's he trying to test? If I know the growth rate in the first period, how well does it help me predict growth in the second period? Let's go along with this guy on his journey. What's the statistical test you're going to run to check to see whether growth in the first period is a good predictor of the growth in the second period? In fact, let me ask you a different question. If I looked at the correlation between these two numbers, if past growth is a good predictor of future growth, what kind of correlation should I get? So remember, this is for each company, growth in the first, growth in the second period. What kind of correlation, positive or negative? I need to get a positive. In fact, if it's the perfect predictor, the correlation should not just be positive, it should be +1. Right? If I have a +1 correlation, I don't even have to estimate growth. I just look at past growth. I use it because it's a perfect predictor. So that's what this guy did. He took these two 5-year periods. He computed a correlation. He spent 2 years of his life doing this, because mostly from collecting the data. And then he wrote his thesis. I'll give away what he found by just giving you the title of his thesis. It became a book. He called it Higgledy-Piggledy Growth. Higgledy-Piggledy Growth. What do you think he found as correlation? What's the worst possible result for you if you want to look at historical growth? What's the worst possible result? 0. Because -1 is a great result as well, right? Because what you do is you take all companies with high growth in the past and use really bad growth, and all companies with low growth and you replace with, he found correlation effectively 0. That's a scary number if you think about how much evaluation we just project out past growth rates, and not just in income, in capex, and depreciation, working capital. So I'm not saying don't look at past growth, just look at it and then move on, because it's a piece of information you will bring into your estimation process, but it shouldn't be the driver of your valuation. Which brings me to the second way you can estimate growth. You can let somebody else do it for you, right? It could be equity research analysts. It could be managers of the company. And what's your excuse for doing it? They know more about the company than I do, therefore their estimates of growth must be better than mine. It's understandable. In fact, especially with management forecasts. And in fact, I ran into an investment banker who didn't like what I wrote about the, I don't know why, the Evercore. And he said, and one of the issues I took up with them is, how come you use management forecasts? And he was very direct. He said, that's what you should be using. They know more about the company than we do. Therefore, what's wrong with using their forecasted growth? Let's start with that the part of that statement that is true. It is, do they know more about the company than you do? Yes, they know more about the inside of the company. They know about projects, they know about cash flows. Absolutely. They are more informed about the company than you do because they have the insides of the company available to them. So the reason for using other people's growth is you're outsourcing this number. You're saying somebody else knows more about the company. Why don't I just do it? You're going to be tempted because for most of your companies, you can get an analyst estimate of expected future growth. I guarantee you. You can find it on Yahoo Finance. You can find S&P Capital IQ, an estimated growth for the next 5 years. And you're going to be sitting there saying, I have a growth rate already. Why shouldn't I just use it? So what I'd like to do is start with that process of what do analysts bring in. And then we'll talk about managers as a secondary role, because most of you don't have access, most of us don't have access to management forecasts, but we do have access to analyst forecasts. Let's start with what a sell-side equity research analyst does. Okay? Anybody who in a previous lifetime was a sell-side equity research analyst? Okay. So sell-side equity research, if you think about it, you think about a lot of valuation, a lot of time with spreadsheets, and that might be true, but a big part of what you do is talking to management of the company, learning more about the company, because sell-side equity research is structured in a very strange way. You're put into an echo chamber, a sector, and the rest of your life, that's all you do is you track those 15 companies in your sector. And you dance this dance between the legal and the potentially illegal. Because the SEC has all these restrictions on disclosure by managers to analysts, but they don't actually restrict managers from talking to analysts as long as they don't disclose material information. So that's a dance you're dancing. Is this? So they can't give you a number, but they can give you a sense. Right? A lot of equity research is spent talking to managers, and a big chunk of your time is not spent valuing companies, it's forecasting earnings per share. And a big sub-chunk of that time is spent forecasting earnings per share in the next quarter. Because there's a game. There's an earnings announcement game that gets played where the actual earnings gets measured against expected earnings. And it's a game, if you're really good at playing that game, that actually will reap you some profits, right? Because if you can consistently estimate better than everybody else what that next quarter's earnings per share is going to be, you can make money around that earnings announcement. It's trading. There's nothing wrong with it. So analysts spend a significant chunk of their time forecasting earnings per share. And some of them even forecast earnings per share a year out, 5 years out, project growth rates. So the big question for much of the last 40 or 50 years has been, given how much time and resources equity research analysts spend on this, are those forecasts of earnings growth better than what you can get by just looking at historical data? We've already told you, I've already told you that historical growth rates are not that good. They should be pretty easy to beat, right? So the first set of studies actually looked at a very simple question. Is the typical mistake you see in a forecast less when you use analyst forecast than when you use historical growth? Remember, the better the forecast is, the smaller the error should be because you're getting closer to the actual earnings. I'll give you the good news first and the bad news later. The good news is all those millions we spend in equity research, tens of millions, does pay off as better forecasts of earnings per share, for the next quarter, but not by much. If you look at the difference between what you get with historical data, which is in the second, so the time series model, you just take historical data and project out, you can see you're gaining about 2 to 3% more precise earnings per share forecast. But there is something that analysts are bringing into the forecast for the next quarter, which was not in historical earnings. That's the good news. The bad news is that's with 1 quarter ahead. If you go to 1 year ahead, you're actually running in place. You're getting pretty much the same forecast. Those 5-year growth rates you get from analysts are consistently almost all noise. You might as well have just used historical growth. You'd have got the same answer. And that's a bit of a puzzle, that all this energy and resources and brain power and data goes in and all the talk with management, and it doesn't show up as more precise earnings per share. So I threw this out to at a sell-side equity research analyst conference in New York and said, what's going on here? Why do you guys spend so much time on earnings forecasts? And how come those forecasts are not much better? And to a person, everybody in the room said, it's not us, it's them. So we're the good equity research analysts, but there are a lot of bad analysts who drag the average down. Implicitly, what they were saying is these studies are wrong because they're focusing across all analysts, and there are some really bad sell-side analysts, and none of them live in New York. So there's a second set of studies I want to talk about, where I want to focus on the best of the sell-side equity research analyst group. Now you're saying, how the hell are you going to come up with this? Actually, I'm helped out by Institutional Investor magazine that every year does this. You know how you have All-America teams for football and basketball? They do an All-America equity research analyst. So they go sector by sector, picking an All-America analyst. And this, if you're a sell-side equity research analyst, is the pinnacle of your life. You've now made it. You're an All-America analyst. It now becomes part of your name. You're John Brown, All-America equity research analyst. That's how you introduce yourself at parties. That's how you introduce yourself to your wife. That's how you introduce yourself to at your schools that you visit. All-America analysts. So I said, you know what, maybe I'll focus on the All-America analysts, see if they're better forecasters. And there's some very interesting results that have come from looking at just those very best of the crop. It turns out that if you look at the year before these people were picked as All-America analysts, their forecasts were actually a little worse than the forecasts of a typical analyst. So if they're being picked as All-America analysts, it's not because of the precision of their forecasts. So what is it based on? It's actually a poll. Basically, they ask people, and the poll is asked, hey, which of these analysts is All-America analysts? And you look down the list of 20, and I actually was one of the people polled one year, and I had to send it back saying, I've never heard of 90% of these people. The 10% I'd heard of, you know how I'd heard about them? Because their names would consistently pop up in journal articles and New York Times articles. So it turned out that the All-America analysts were not exactly the very best analysts. They were the highest profile analysts, which means if you're a Goldman Sachs analyst or a Bank of America analyst, you start off with an advantage over a smaller bank simply because you have a higher profile, or you work closer to CNBC, or the person at CNBC likes you. Whatever it is, you have a higher profile. But here's where the magic happens. They're not that good at predicting earnings the year before they're picked as All-America analysts. But in the year after they're picked as All-America analysts, the magic seems to happen. They magically become better than the average analyst at forecasting earnings. You think this is proof that self-affirmation works, that self-esteem What do you think is happening the year after you become an All-America analyst? It's improving your forecast. That's the price impact, though. That's different. So the price impact also goes up. But why is the quality of your forecast itself going up?
You get better access.
This is the dance. The dance gets a little easier. Remember I said you call the company. Now you're no longer John Brown, equity research analyst. You're John Brown, All-America equity research analyst. All of a sudden, people answer your phones who did not answer it before. I know this is not supposed to be the case, but you get marginally more fuzzy information. That's legal, so you get more, and that then allows you to then kind of come up a little closer to the earnings forecast. You're right, the price impact obviously increases because you now have a bigger following. The Wall Street Journal picks you up. But here's, I think, the final piece. Sell recommendations have a much bigger impact on the price than buy recommendations. So buy recommendation, the price goes up. Sell recommendations, the price goes down. Buy recommendations, the price goes up, but it very quickly fades. So 6 months later, you look at the stock, or even 3 months later, it's gone. Sell recommendations, the stock drops more, and it stays down. So sell-side equity research reports that have sell recommendations seem to have much more oomph to them than buy recommendations. Why do you think that is? Which is more common, buy or sell recommendations? Even after all the reform of sell-side equity research, buy recommendations outnumber sell recommendations, probably 6 to 1, 7 to 1. It used to be 19 to 1 in the early part of the last decade. In 2000, it was 19 to 1. It's now down to 6 to 1. In fact, sell-side equity research analysts hate to say the word sell, and I don't blame them. Because once you say sell, what happens next? Remember we talked about access? Those 15 companies you called, you put a sell recommendation, you're burning your source, right? I mean, remember the thing about journalists burning it? You burn your source, the guy just hangs up on you. Which is why equity research analysts have to have these extraordinarily convoluted ways of telling you to sell without ever saying SELL. Like by doing what? Like lowering you from a strong buy to a weak buy. Get the signal. He's saying sell now, don't wait, sell 5 minutes from now. Don't wait even the 5 minutes, sell right away. Or numbers. This is really the slipper. We've lowered the stock from a 7 to a 5. What the heck does that even mean? But it's really sell now. We don't like the stock. Here's the other interesting thing that I want you to watch. Because the sell-side equity research analysts also give a target price. That way you can never pin them down on what the price is today because it's always a year up. But if you take a look at the target price, you know what the biggest is? And those target prices can go up and down. Goldman Sachs, a couple of days ago, lowered its target price on Tesla to 185 from 240. What's happened over the last 3 months that you think caused the price to go down? The stock price for Tesla 3 months ago was 225. Now it's down to 205. It's treading water because of the Solar City deal. The biggest driver of equity research analysts lowering target prices is a drop in the stock price. So basically, target prices chase the actual price up and down. It's a very depressing perspective on sell-side equity research because it says, look, you're playing the pricing game. Just play the damn pricing game. Don't tell me about value. You really want to play mood and momentum games. That's essentially what this is. And that's led me to what I think, I mean, let's face it, sell-side equity research is in turmoil. Turmoil in what sense? The number of sell-side equity research analysts is shrinking. Clearly in the US, but it's coming around the world. It's shrinking because the value added from the research is dropping off. People are not believing the research. So if I were asked to identify the reasons I think sell-side equity research is in trouble, here are the 5. The first is that tunnel vision that I talked about, which is you're put in a sector and asked not to worry about the rest of the world. So if I make you the sell-side equity research analyst for social media companies, after a while you think 10 times revenues is cheap. Why? Because that's all you see. That's tunnel vision. I think it's a mistake to actually keep people in the same sector for the rest of their lives. I know why people do it, but by doing it, you get this tunnel vision. You're so caught up in your sector, you forget about the fact that your sector can be seriously mispriced. The second is what I call lemmingitis, the desire to be close to everybody else. Goldman Sachs lowers Tesla's target price. I guarantee you in the next couple of weeks, you're going to see other equity research analysts following Tesla lowering their prices as well, because you never want to be too far away from the consensus. Because if you screw up, then you have lots of company. So I'll call that lemmingitis. The third is Stockholm Syndrome. You heard of Stockholm Syndrome, right? This is when you get kidnapped, and after a while you start identifying with the kidnappers, and you start to sympathize with them. I mean, Patty Hearst had that with Charlie Manson. You're saying, what's this got to do with sell-side equity research? If you step back and think about what sell-side equity research is supposed to be, it's supposed to be analysts looking at companies from an adversarial relationship. Basically adversarial because you're supposed to be looking at these companies and saying, are these companies good investments? Are they well run? Are they badly run? It's not to defend the company against all comers. Take a look at some sell-side equity research reports on Tesla. The analyst actually is a stronger believer in Tesla than Elon Musk is. I actually listened in on a conversation where a sell-side equity research analyst in Tesla told Elon Musk he was not being optimistic enough about the company and viewed it as his job to defend the company. It's a Stockholm Syndrome. You've forgotten where your job ended and where the company's objectives came in. A lot of factophobia. I'm a great believer in storytelling, but if I read an equity research report and it's 150 pages long, already I know I'm in trouble. If it takes you 150 pages to tell me something about a company, then you're telling me a lot of stuff that doesn't matter. So you need to kind of bring your stories in with numbers. You cannot avoid the numbers, even if you're telling me the greatest story on the face of the earth. And finally, and this is less of a problem in the US than it used to be, but even now there is still this potential problem of if you work for a house at which you're a sell-side equity research analyst and they have other business to do. I know your job is to be a sell-side equity research analyst, but you cannot tell me that that other business has absolutely no impact on what you do. I will not trust an equity research report from Goldman Sachs on Tesla, ever. Why? Because I know that they were the investment bankers who, so the last equity research report actually came out just before. Remember the one which was optimistic, $230 price, projected. It came out just before Tesla was making a new equity issue, which was being co-led by Goldman Sachs. You can tell me there are Chinese walls, but I know there are holes in these walls and you go up them and down them and you climb over them. There's no way you can tell me that the equity research department exists in this bubble and they don't know about the fact that even better. And that was the core of the problem in 2000, and supposedly they passed rules to stop this from happening. But you can never do it. It's really difficult to essentially value a company in a vacuum, knowing your company has other relationships from which they can make money. So the bottom line is sell-side equity research has to kind of reform itself, or nobody's going to use the reports anymore. People don't believe these analysts anymore simply because, it's not because they don't do their homework, but because they're viewed as far too biased. So what's the bottom line? When you sit down to value a company, look up the analyst forecast of growth in the company. But don't dress it up with more importance than you should. It's not a number that reflects incredible information you don't have access to. So don't view it as something that should be driving your valuation. So here are three propositions. There's far less private information in equity research analyst forecasts than you think. You think equity research analysts are listening to managers, learning all this special stuff. There's far less than you think. It's mostly very fuzzy information. The biggest source of information for equity research analysts is in fact the company, and that is a problem. It's a problem because there's bias in this process. It is also why all-America analysts magically become better forecasters after they become all-America analysts. And the third and final suggestion I would have is find out what that sell-side forecast is. If it's different from what you're forecasting for your company, which it probably will be, then stop and ask why. Maybe there is something that those analysts are thinking about that you're not. So check and make sure. Don't assume that you're right and they're wrong. but don't automatically assume that analysts already know something that you don't. Any questions about analyst forecast? Which brings me to my third and final way of thinking about growth. I'm going to set up a very simple way of thinking about growth, and I'm going to go back to pure algebra and a very simple company. So let's assume you have a company that right now is $1 billion invested in existing projects on which it makes a 12% return. 12% times $1 billion is $120 million in earnings. So right now they have $120 million in earnings. Next year, they are planning to invest $100 million in new projects on which they will continue to make 12%. So if you think about next year, you now have $1.1 billion invested in projects making 12%. Your net income is going to be $132. You see, who cares? If you think about the growth they get next year, it's coming from the addition they're making to their investment base, that new investment, and the return they make on that new investment base. In fact, the change in earnings is coming entirely from new investments. Now let me modify this into an equation. If you take that $12 growth, so if you look at the $12 change in earnings, that's about a 10% growth rate, right? 12 divided by 120. Let me break down how I could get that growth rate. Out of the $120 million in earnings, they're reinvesting $100 million back into new projects. I'm going to call that your reinvestment rate, how much you're putting back in the business. I'm going to call what you make on your projects at 12% as a return on that new investment. I can actually write the growth rate of 10% as my reinvestment rate, 83.33% times 12%. That is at the core of what's called the sustainable growth equation. In the sustainable growth equation, the growth in earnings for a company is a function of how much you reinvest, that's the reinvestment rate, and how well you reinvest, that's captured by what you make on that investment. And it works only if your return on equity in your existing investments is staying fixed at 12%. In fact, there's another way you can grow without reinvesting a single dollar, which is to do what? Improve your return on existing investments, right? So if I take my existing investments and improve their return from 12 to 13%, I get growth from efficiency. So if you think about growth, broadly speaking, there are only two ways you can grow. You can grow with new investments, or you can grow by becoming more efficient. Each has its place in valuation, and each has its limits. Growth from becoming more efficient is finite growth. You see why I call it finite growth? You can cut costs and grow for only so long until you run out of costs to cut. But sustainable growth you can maintain forever, because as long as you can maintain that reinvestment rate and that return, you're going to be able to generate the growth rate. So the question is, how do we measure how much you reinvest and how well you reinvest? And that depends on what kind of valuation you're doing. There are three ways. Remember the three measures of cash flows: dividends, free cash flow to equity, and free cash flow to the firm. If I'm looking at a dividend discount model, what am I doing? I'm counting the dividends you pay out as my cash flow. I'm looking at the retained earnings as what's going back into the company. So my reinvestment in the dividend discount model, whether I like it or not, is the retention ratio. So it becomes 1. So if I'm paying out 30% of my earnings in dividends, I'm acting like the remaining 70% gets reinvested, which might or might not be true. It might be just holding it as cash, but that's okay. That's treated as my retention ratio. How well I reinvest is measured by my return on equity. So when I think about reinvestment in the dividend discount model, I capture the retention ratio, and when I think about how well you're reinvesting, I capture the return on equity. So if I'm a company with a 70% retention ratio and a 20% return on equity, I'm going to have a growth rate in my dividends of 14% a year. If I'm doing a free cash flow to equity model, and I'm doing it based on non-cash assets, now I'm keeping cash separate, then my reinvestment rate, I can't use the retention ratio anymore, because I might be retaining money but not putting it back into projects or into working capital, just holding it as cash. So here I'm actually going to look at what your actual reinvestment is. And we've already talked about what that is in the context of cash flows. It's net capex, it's reinvestment in long-term assets, including R&D and all that other stuff, plus change in working capital. But because you're looking at this from an equity perspective, if you can raise some of that reinvestment from debt, it actually reduces your reinvestment. So the equity reinvestment is net capex plus change in working capital minus whatever portion of that I'm getting from debt. That becomes my equity reinvestment. Dividing that by my net income gives me an equity reinvestment rate. So I've gone from a retention ratio to an equity reinvestment rate. I'm trying to do the same thing, but I'm trying to do it more precisely by looking at what you actually invest. when I look at what you're making on your projects, I'm still going to do a return on equity, but instead of muddying up the waters by including cash, which I tend to do, right? So if I take Apple, I divide net income by book equity. My net income includes that paltry income they make from cash. My book equity includes the $240 billion in cash. I'm going to get a much lower return on equity than if I took cash out of the process. So I'm going to compute a non-cash return on equity by looking at the portion of the net income that doesn't come from cash and the portion of the book equity that is non-cash. So my measure of how well I'm reinvesting becomes my non-cash return on equity. Very subtle change: retention ratio, equity reinvestment rate, return on equity to non-cash return on equity. Let's take one final step. Let's suppose you're valuing the firm. There I'm looking at after-tax operating income, not net income, right? My reinvestment rate there is my net capex plus change in working capital, that reinvestment I put in as a percentage of my after-tax operating income. Why? Because I'm doing a free cash flow to the firm. And how well I reinvest is going to be measured not by my return on equity, but my return on invested capital, all my capital, debt plus equity. And my after-tax operating income is the collective income I make on that. So it's the same equation. And one of the things I'd caution is if you take each of these equations and treat them as separate equations, by the end of this class, you're going to have 10 pages of equations because you're just writing the same thing in different ways. So just think of them as the same equation written in 3 different ways, depending on what you're doing. So let's start at least on long-term growth in earnings per share. Let's start simple. Because I'm looking at earnings per share growth, I'm going to stick with the old dividend discount model version of growth, which is retention ratio times return equity. So as I said, retention ratio is whatever you don't pay out. So if you have a 20% payout ratio, retention ratio is 80%. Return on equity is what you're making on your projects. So if a company is in steady state, you know what I mean by steady state? Its retention ratio is settled in, your return on equity is settled in, they're not going to change. Your expected growth is a product of those 2 numbers. And there's actually a very interesting implication that comes out of this. If you're in steady state, what's the highest retention ratio you can have? It can't be more than 100%, right? So your retention ratio can't exceed 100%. I've already given you a cap on your future growth. Your growth cannot exceed your steady state return equity. So if you're a company with a 10% return equity, I have some depressing news for you. If you're mapping out 10-year plans to grow at 30% a year, it's not going to happen on a per share basis. Not with that return equity. So the return equity becomes your cap on the growth rate. So last problem for today, and we'll end. So I took Wells Fargo. Okay. Wells Fargo in 2008, pre-crisis. This is what the numbers look like. Their retention ratio based on 2008 earnings and dividends was about 45%. So they paid out about 55%, they retained about 45%. Their return on equity based on 2008 numbers was 17.56%. So in June of 2008, if you had asked me to value Wells Fargo, and I made the assumption that those 2 numbers were sustainable, my expected growth rate would have been about 8%. I told you it was the last slide, I lied. This is the last slide. Now the crisis happens. It's only 6 weeks after that process. None of the numbers on Wells Fargo have changed. But let's say because of the crisis, you think that regulatory capital requirements, which are really equity requirements for Wells Fargo, will be higher by 30% going forward. So assume the net income is still the same. It's a very optimistic assumption. Let's say the net income stays the same. But now Wells Fargo will have to bring in more equity into the business because of regulatory requirements. Let me take it piece by piece. What's going to happen to your return equity if I now require to have more book equity to deliver the same net income? It's going to go down, right? So anytime regulatory capital ratios go up at banks, and if you looked at Deutsche's Tier 1 capital ratio going back to 2008, and this is not just Deutsche, across the board banks have seen the regulatory capital requirements rise, returns on equity go down. If returns on equity go down and you keep the payout ratio what it is, your expected growth in earnings per share for the same net income is now going to be much smaller. Try working out the numbers. When we start class next session, we'll start with those new growth rates you'll have for Wells Fargo with the changes brought in and move on from there.
shouldn't you do this? Because you said if we have 10% equity now, we can only expect 20% or 2 to 3 years down the line. But if the firm is expecting to get an allocation, for example,
And you're not in steady state.
no, but if the firm is not steady state,
Then you'd have to show the effects of changing the firm equity each year. In fact, if you have changing debt, it's best not to even look at it on an equity basis.
You remember in Deutsche Bank you had the reinvestment to keep up with the equity. Why do we discount it? It's a broader question. Like even if you have negative
You
earnings.
don't have to bring it up in the future year. Why wouldn't you discount it?
So the way I was thinking
Yeah.
is like, let's say next year I need $1 billion in equity, and my cost of equity is 10%. Then why am I saying today I only need 900 million? Because I don't have a magical way of making it $1 billion next year, right? Like, or maybe my logic is wrong here somehow.
The question is saying, I have to bring up the regulatory capital, therefore you'd use a risk-free rate. I mean, the debate is about what discount rate you use.
Yeah, exactly.
If you feel that the regulatory capital requirement you have to come up with is a number that is going to be almost required number.
Yeah, exactly. Because the variation around it is not that much, right? Because
well, it's a function of what happens to risk-adjusted assets and your return equity, right? So in a sense, it's not an endogenous number. It's
okay, yeah.
Right? So
it's driven by other factors.
It's driven by other factors. So if it were in fact a required number and you had zero growth in risk-adjusted assets and this was a number you had to come up with just to survive, you could use a risk rate. That's a decision that's actually consistent with cash flows being discounted back at a rate that is consistent with the riskiness of those cash flows. It's like if you're a toll road company and you have negative cash flows for the next 5 years, and you've contractually set yourself to have those negative cash flows.
Then
You might say, look, to discount those first 5 years of cash flows, I'm going to use a cost of debt.
yeah.
Not a risk-free rate, because obviously you can default.
Yeah.
Use a cost of debt as your discount rate to get to year 5. And once you're operating